Good afternoon, everyone. I'm David Paul. It's great to be here, great pleasure to be here. Quite a few people in the audience I know well, and some new faces. My background is checkered. I've got a degree in engineering. I've got an MSc in metallurgy. I've got a PhD in mathematics, all of which I assure you is totally and utterly useless for taking money out of markets regularly and consistently. And without a doubt, the thing I've done in my life that's allowed me to be reasonably successful in the stock market is that in my youth, I was an officer in the Royal Marines. And that's given me a level of confidence and discipline that I've drawn upon for a very, very long time. And ladies, I can still fit into the uniform 45 years later. Okay? A long time, thank you. That's very kind of you at the back. Very kind of you. So I put on my first trade in October 1982 by pure accident. I was playing really good rugby at the time, and I went to South Africa to play professional rugby. And I was in an office with an old fellow who was share trading, and I watched him and I watched him. And after watching him for about a year and saving up some money, I put on my first trade in October 1982. It was a winning trade, and they say if your dad takes you fishing and you catch a fish the first morning, you fish for the rest of your days, and that's what I've been doing. I traded while working for De Beers from October 1982 to April 1988, and in April 1988, I made 3 times more trading than I did as the head of research for De Beers, so I cut the corporate umbilical cord, and I've been trading on my own ever since. Along the way, under duress, I may add, I was asked to do some seminars in the stock market because one night I went to a talk and the speaker had laryngitis. So they asked me to stand up and take the meeting. It went well. And I was asked by a stockbroker in the audience to come in and coach his traders how to become more consistent. And that led to a career in coaching traders, and I've coached traders all over the world, mostly in Southern Africa, Southeast Asia, but on all the London banks. And that led to where I'm at the minute. I've been showing private investors how to go about increasing their consistency with the VectorVest program for, I suppose, nearly 10 years now, and that's where I met quite a few people here. That's my background. I haven't got long, so I need to keep going. Those of you that know me well will know that I find the trading quite easy, but the technology quite difficult. I have to put up a disclaimer where I am fully authorized to give financial advice, but I can't give financial advice, especially the young man that wanted the tips in the front row, unless, sir, I've sat down with you and done a long and a very detailed fact find. I'm allowed to talk about the shares that I have myself, but I have to make it very clear that they may not be suitable for you. Okay. So that said, we can move on. So what we're going to talk about is the VectorVest system of analyzing shares, market timing. There's a good time to be in the market and an awful time to be in the market. I think you would agree. Last October, November, December wasn't the greatest of times to be in the market. Am I correct? What? And you could have been short. It depends where you're looking from. You're quite right. Okay? But for most of us that are long only, October, November, December wasn't that great. But January, February, March has been wonderful. So there's a good time to be in the market. There's an awful time to be in the market. And then at the end, our most conservative, worry-free investment strategy. And folks, we have a process at VectorVest, and the previous speaker at Scottish Mortgage, they have a process as well, and the next speaker have a process of trading. So whatever you get out of today, you need to go home and you need to think long and hard about your own process, where you want to be. Because folks, if you keep your mind in the moment and focus on the process, the geld, that's Afrikaans, spent too long in South Africa, the geld will take care of itself. Okay, so what we're going to talk about is the VectorVest most conservative process of building wealth in the stock market in a few minutes a day. We have standard retirement portfolios, which I'm going to talk about at the end of this. We have aggressive portfolios. For that young fellow in the black coat, I can just see you'd be an aggressive trader. And we have portfolios in between, which we would class as prudent. I have 80% of my own money in the conservative stuff and 20% in aggressive. That's my own stance. And if I was managing money for you, lad, that's what I would do. Okay? If you ever manage a fund, people will come to you. Is that your son?
Yeah, that's my money.
Okay. And they'll say, if I'm managing your money, sir, you would come to me and you would say, I understand risk. Put us into the aggressive fund. Unfortunately, you find that as soon as you've got one little bit of red on that report sheet, people don't understand as much about risk as they would like to believe. And the telephone is red hot and you're holding it out here. Okay, so 80-20 is a good mix.
What about 80 in the aggressive fund?
80 in the aggressive fund. I was like that at one stage in my life, and my son, who's a fund manager in Johannesburg, is like that now. And I'm keep telling him take small little steps, but like all sons, the only time you hear from them is when they need to borrow money. Okay, so so he doesn't listen. So I'm happy to make this promise. You can read that for yourself. So the VectorVest system of analyzing stocks, and it focuses on value. Now, my dear grandfather told me a long time ago, he died in 1968, so it's a long time ago. He said that the only way to make money in anything is to find the value of something and then pay less for it. Yeah, whether you're in used cars, used caravans, or property, that's the key. So at VectorVest, we put a value to every share in the London stock market every single day. If you're quantitatively orientated, nip down to our stand and I'll show you the sums. It's in chapter 3 of a little book called Stock Strategies and Common Sense. But we put a value, it's a rigorous process, that word again, we put a value to every share in the market every single day. And certainly for the conservative portfolio, we would only be investing in shares that are trading considerably less than that valuation. And value is all about earnings, inflation, and interest rates. The classic text on it is Benjamin Graham's text written in the 1930s that I'm sure many of you will have read, and Graham and Dodd in the 1930s. So we put a value to every share every single day. We put a price appreciation potential where we actually compare the earnings flow of every company with what we would get from a AAA rated corporate bond. And that's our measure of the earnings upside. We call it relative value. So what we do is that we forecast the earnings of every company on the stock market for the next 3 years. We assume that those earnings will be fully discounted into the price. We work out what the price will be. We take the projected price, we subtract the price today to calculate the upside. And we divide the upside by what a AAA rated corporate bond will pay over the same period. Anything above 1.3 ranks as excellent. In other words, it should outperform a corporate bond by 30% over the period. If a share has got a relative value of less than 1, that means it's going to underperform a corporate bond in that period. And you've got to say to yourself, why would you want to take something as a position in something as intrinsically risky as a stock if you could get more reward from a AAA rated corporate bond? I believe that's the most important number in VectorVest. It drives the share price and it's a function of forecasted earnings per share. And in my 35 years of investing, the thing that drives the share price to the highest degree of correlation is earnings per share growth. And Ben Graham, Buffett's mentor, he said that earnings per share growth is the engine that drives the share price. So those of you that are technicians, it's not moving averages that are driving the price up the page. The price is going up the page because that company will make more money next year than it did last year. Simple as that. Earnings per share is absolutely key to the exercise, and relative value is a big, big part of it. Relative safety, very important for today's discussion, because relative safety looks at all 2,000 companies in London that we follow, 10,000 companies in the US. We buy the financial data from Thomson Reuters. We suck up the balance sheet, the income statement, the cash flow statement, margins, suck them all in, and we spit out one single number which represents the safety and the predictability of the earnings on a scale between 0 and 2. Above 1, fair. Above 1.3, this is a company that's making lots and lots and lots of money. And all those ghastly financial ratios, I'm still a mechanical engineer, are getting better. Now, if you are a very conservative investor, you're not. You're aggressive. If you're a very conservative investor, then you would want to push the relative safety right up there. And today in our worry-free investing, that's what we're going to do. We're going to look at those shares with the highest relative safety. If you are an aggressive investor like this youngster here, then you really wouldn't worry about relative safety at all. And that's what my son does in Johannesburg. He looks for shares that are undervalued, shares with an enormous relative value, function of earnings per share growth, and he doesn't much worry about relative safety. Why? Because he's sitting in front of a deck of monitors all day. From 8 o'clock in the morning till 6 or 7 o'clock at night, and he sits and he watches and he manages his risk proactively. Now, so I get my glasses manufactured at the optician. They cost a fortune, but I keep losing the damn things. So every now and then I've got to go to Marks and Spencer's to buy a pair. You know, the ready-made ones? And I'm on 3s already. I think it goes to 3.5, and I've been sitting in front of bloody charts for half of my life. I remember once upon a time having a bad dream, and I was at the gates of heaven. And St. Peter said to me, "What have you done to benefit mankind?" And I said to him, "Well, I sit and watch these little candles go up and down all day." And I woke up before he gave me a decision, okay, as to where I was going. So I've been watching screens for far too long, and I want to get away from them, okay? But my son is like this young fellow here. He doesn't worry about relative safety. He manages risk proactively. If the relative safety is high, it means that there are less surprises. We can't get rid of surprises completely. There's just fewer of them, okay? And the next number, folks, is relative timing, where we measure the trend. Everybody measures the trend, but the first numbers are proprietary, but this is our own measure of the trend. Again, on a scale between 0 and 2, if the trend is above 1, it's rising. The further above 1, the faster it's rising. So it's a measure of both the direction of the trend and the momentum of the trend, the speed of the trend. And momentum is very poorly understood, because did anybody drive here today? Who owns a car? All right, you've got a momentum indicator in your car. It's called the speedometer. And what it means is that if you're speeding up, there's a higher probability that you're going to keep going than if you're slowing down. Will you meet me on that one? If you've got your foot on the petrol, there's a higher probability you're going to keep going than you've got your foot on the brake. So technicians look at momentum in exactly the same way. If the speed of the price is rising, there's a higher probability it's going to keep going. It's a probability, young man, not a certainty, because you and your car could hit a wall and you'll stop dead. Okay? And similarly, in the stock market, there could be a trading statement come out where the thing, all right, Tesla was trading upwards until that trading statement came out the day before yesterday, okay? So a measure of both the trend and the momentum of the trend. And then what we've done is we put them all together. And the master indicator, VST, puts together value, safety, and trend. And if you are a momentum trader, like this young fella again, you'll never wear that jacket again, eh? Then you would be looking at VST a lot, because it's very useful for momentum trades. In our conservative strategy today, we're going to be sorting stocks not by VST, but by safety and predictability of earnings, because we don't want surprises. Okay, so we put a stop loss to every share in the market every single day. Stop loss is important because you have to cut if you're wrong, And it's also important for those of you that have done any trading to calculate your position size. And I haven't got time to go into that in a great deal of detail. If you come in our stuff and if you stop by the stand, I'll do all of that. It's quite a sexy moving average in that it's adjusted for the fundamentals. If the fundamentals of RV and RS are good, we widen the stop loss. If the fundamentals are not so good, we tighten the stop loss. So we give good shares with great fundamentals more room to move. Right. We put a buy-seller hold to every share in the market every single day. So you can see when you should be buying into it, when you should be running like hell, and when you should be sweating it out. And we do a bit of sweating out at times where the thing's going nowhere, where you're waiting. Who's ever sweated in a position waiting for it to go? Many of us. That's the way it is. Okay? Markets do not move in straight lines. They move chaotically. They go up, they do nothing. And then they fly up the page again. So they go sideways for a while. Just got to give them a bit of patience. Patience, discipline, money management, and a sound trading system, in that order. There's good time to be in the market. There's an awful time to be in the market. And the first part of the VectorVest process is to work out whether the market is rising or falling. Everything follows from that. I know that's controversial. Many people will say it can't be done. Market direction, easy to ignore it. It's like this. Have you ever been on one of those contraptions? I've got a problem. I've got an MSc in metallurgy, and I'm always looking. If I see a rusty bolt, I don't want to go on them, you know. You can know too much in life. It takes forever to get up, and then it comes down very quickly. Am I correct, young fella? Okay. The stock market's like that. It takes many years to get up there, and then it falls like hell. Now, my father told me that when the London stock market made a high in 1969, it took 20 years to break that high in real money. 20 years. Have you got 20 years to wait? Not looking good, mate. No, not looking good from here. Okay, it's a probability game, and maybe you need to speak to Jim about that Juvenescence bit, but that's the London stock market, folks. This is our measure of the London stock market, and you can see the red and the green triangles, and that's our longest measure of the trend. And the longest measure of the trend, we were out of the market here, and the longest measure of the trend kicked in again on the 9th of January. Now, every Monday afternoon, I do a webcast to VectorVest members, and I go through market timing every Monday afternoon for about 15 minutes. It's recorded. You can listen to it anytime if you're a member. And at the moment, I had to do this a few days ago to get it through to the master investor people. But the London market moving up, and both the short-term trend of the London market and the long-term trend are moving upwards. That's a rude sign you've just given me there. Is that 5 or 2? 2 minutes. 2. I thought it was a rude sign. How to build a worry-free portfolio? Well, relative safety is the key. So we want to bring all of those shares that have the highest relative safety to the top of the pile. And I've written a search. And the search is quite simple. I'm looking for shares that are above 50p, that have a reasonable volume. The 50-day moving average of volume is greater than 50,000 shares. They're not on AIM. Now, there's nothing wrong with AIM shares, but for this conservative portfolio, they're all in the main market. Very importantly, I want the stock price to be less than the stock value. The only way to make money in anything is to find the value of something and then pay less for it. Naive, maybe, sounding, but it works. And the stock's recommendation is not a sell. In other words, it can either be a hold, sweating it out, or on a buy, moving up the page. And I sort the darn things by relative safety. And brings the shares with the highest track record, the highest record of making money to the top of the pile. And I did this I started this when we got our confirmed up signal, which is our longest measure of the market. So when we get a confirmed up, we buy higher RS stocks. And if we get a red signal, which is a confirmed down, we stop all buying and we watch our stop losses carefully. And that's the process. And that's what it's done this year, folks. Now, if you come down to our stand, since I sent this through to Master Investor, this 15.77 is now at 17.5. So the London stock market is up 7.3%. I admit it's a good year, but remember, we only want to be very active in the stock market when the overall market is rising. When the overall market is falling, then we certainly don't want to be initiating any new positions, and we want to be watching our stops very carefully on those positions that we have. If we get stopped out of any positions in a sell-off, then we keep a cash position. When we get the next buy signal, we rerun the search, and we're fully invested again. Now, I've been testing this for 20 years. It's totally mechanical, and it, on the American market, has produced a 17% compound rate of return over that 20 years. The search can be plugged into the portfolio manager, and the portfolio manager doesn't trade for you, but it will send you an email every evening when there's something to be done. Now, on the 20 years of a test, it traded on average every 6 weeks. Okay, so it's going to be boring for an active investor like yourself. But the objective, in the words of my long and dear departed rugby coach, was let the ball do the work. Okay, so we want to find undervalued shares with incredibly strong track records of making money. And we want to buy into them when the general market, as defined by a long-term trend-following system, is rising. And if it keeps rising, we stay in the stocks. When it starts to fall, no more buying. Watch your stop losses carefully. I'm being hounded, I think, but we're downstairs, folks. And if you want to come along, the lady who runs our London user group, Susan Thornborough, is there, and we'll show you the system working with the greatest of pleasure. The system, you can test it for 30 days for a $5. If it's not the best $5 you've ever spent, you can have your $5 back with the greatest of pleasure. Okay, thanks very much indeed. Bye-bye.